historically, small cap stocks have outperformed large cap stocks over time. This is because small caps tend to have more room to grow as compared to their larger counterparts. Like if you had just invested in Nvidia back in the 2000s, way before their crazy run-ups, you would have gotten some insane returns. But the problem with that is that for every successful small cap company that you see, there are hundreds of them that just go chibaboom 18 levels into the ground. That's why it's safer and smarter to invest into small cap stocks via ETF. That way, you will get to diversify your risk while enjoying potential upside, especially right now, as small cap stocks have been largely ignored over the past few years, but have started to pick up again as interest rates are about to go down. In this video, I'll be sharing some of the best small cap ETFs that you can invest in, including some Ireland domiciled names for my non-viewers out there to save on fees. At the end, I will also share which are my personal favorites as well as what's the best way to invest in them if you choose to do so. As a bonus, I've compiled all this info into this super detailed spreadsheet, which you can download for free, link down below, yeah? Also, do join my 10,000 members Telegram chat group to discuss or ask any questions that you might have. First up, we have the 4 ETFs tracking the most popular small cap indexes: the S&P Small Cap 600 Index, Russell 2000 Index, CRISPR US Small Cap Index, and the Dow Jones US Small Cap Total Stock Market Index. And here's how they are different. All indexes start by ranking stocks according to their market caps. The S&P, Dow Jones, and Russell will then divide stocks according to their ranking. For example, S&P will take the 600 stocks between the 901 position to 1500 position and put them into the S&P Small Cap 600 Index, while Russell will take the 2000 stocks between the 1001 position to 3000 position and put them into the Russell 2000 Index. As for CRISPR, rather than dividing stocks based on their absolute ranking, they divide stocks based on their cumulative market cap. So, for example, the biggest 85% stocks will go into the CRISPR Large Cap Index, whereas stocks that fall in between 85 to 98% percentile will go into the CRISPR Small Cap Index. Now, if you look at the number of holdings each index has, what you'll notice is that the S&P Small Cap 600 Index only has around 600 stocks, while the rest have over 1,000 stocks. This is because the S&P Index has one important difference. It requires its holding to be profitable within the last 4 consecutive quarters, including the latest quarter. This additional criteria allows the S&P Small Cap 600 Index to outperform the Russell 2000 Index over most periods. Not just that, the S&P Small Cap 600 Index has also outperformed the Dow Jones US Small Cap Total Stock Market Index. But interestingly, the S&P Small Cap 600 Index underperformed the CRISPR US Small Cap Index in most periods. This is due to how CRISPR divides its stocks. Some stocks that are considered mid-cap in other indexes are being considered as small cap in CRISPR. So if you compare the stock styles of both ETFs in Morningstar, you will see that IJR's holdings focus more on small cap value stocks, while WeB leans a little more towards mid-cap with a bit more growth. Because of this, WeB is able to outperform IJR in most periods. Now, let's go through both ETFs for a while. IJR has a low expense ratio of 0.06%, while WeB has an even lower expense ratio of 0.05%, which means for every $1,000 you invest, you only need to pay 50 cents in fees every year. And unlike the S&P 500, where the top holdings heavily dominate a huge part of the ETF, what I like about both IJR and WeB is that both their holdings only take up less than 0.6% of the weightage. So even if some of the holdings were to fail, they won't crash the entire ETF. Not just that, their holdings are also evenly spread out across a few sectors, like financials, industrials, and consumer discretionary. Both of them pay around the same dividend yield and have a 4-star rating from Morningstar, which means that they have a good risk-adjusted return. If you are looking to start investing, here's why you should consider Webull. First, Webull pricing is super competitive. For the US market, you can start investing from just 50 cents per order with no platform fee. Or if you trade the Singapore market, both the commission fee and platform fee start at just 80 cents. 2. Webull has a ton of useful data to help you make smart investing decisions, such as company financials, analyst ratings, and up-to-date news. 3. You can invest automatically in your favorite US stocks and ETFs with as little as $5 from investing every trading day all the way to every month. New users who use my exclusive link to sign up to Webull will be able to get up to $350 cash vouchers when you deposit $10,000 by 29 November 2024, 3:59 PM Singapore time. Make 5 US buy trades within 30 days from the first deposit while maintaining the funds there till 31st January 2025. Plus, you will also unlock up to 6.9% per annum yield for USD Money Bull for 30 days when you deposit a minimum of $2,000. This is on top of commission-free trades for US stock trading for 1 month, commission-free trades for Singapore stock trading for 3 years. And both new and existing users will also get to enjoy US options free commission when you trade a minimum of 100 options contracts in the month. So if you're interested, do sign up to Webull using my link down below. And let's get back to the video. Moving on, the next 3 ETFs on the list are Ireland domiciled ETFs, perfect for non-US residents who want to avoid the 30% dividend withholding tax. We have IDP6, which tracks the S&P Small Cap 600 Index, R2US, which tracks the Russell 2000 Index, and lastly, BBSC, which tracks the Morningstar US Small Cap Target Market Exposure Extended Index. Similar to just now, you can see that the S&P Small Cap 600 Index ETF outperforms the Russell 2000 Index for longer time periods, though it gives around the same return as the Morningstar Index. This is again due to how the Morningstar Index divides its companies according to the percentile rather than absolute ranking, which in this case, they define small cap stocks as stocks that fall in between the 96th and 99th percentile. Because of this, BBSC gets holdings that lean a little more towards growth. So let's compare IDP6 to BBSC. IDP6 has a whopping 0.3% expense ratio, which means for every $1,000 you invest, you will need to pay $3 in fees every year. Meanwhile, BBSC only charges a 0.09% expense ratio. Both of them have around the same number of holdings, but more importantly, their holdings as well as sectors are well spread out, with BBSC focusing a little more on healthcare and information technology. Lastly, IDP6 got a 3-star rating from Morningstar, while BBSC got a lower rating of 2. Though, if I had to choose between the two, I would prefer to go with BBSC due to its lower expense ratio. The next 3 ETFs are based on existing indexes, but modified to tilt towards a certain direction. First, we have VBR, which tracks the CRISPR US Small Cap Index that we have seen earlier, but this time it focuses more on value stocks. So what's happening is that the index looks at these holdings, then based on several factors, split the holdings in either the value camp or the growth camp. Then we have RWJ, which tracks the S&P Small Cap Index, but instead of weighted by market cap, it reweights its holdings by revenue earned. The idea is that companies that can earn more revenue may experience higher growth, higher profitability, higher market influence, and thus higher return. Lastly, we have USSC, which tracks the MSCI USA Small Cap Index and reweights it to focus on stocks that have lower valuation. So it's a little similar to the first index. So do these tilts work? If you compare these 3 ETFs against all the previous ETFs, it does seem like they are working, as these 3 ETFs are mostly giving higher returns as compared to their non-tilt counterparts, especially both RWJ and USSC, which are giving the highest return. Though, their downside is that their expense ratio is also the highest at 0.39% and 0.3% respectively. Also, if you want to save on dividend withholding tax, you will need to go with USSC, which is an Ireland domiciled ETF. Finally, the last 2 ETFs are actively managed ETF and are from this fund manager called Avantis. If you have not heard of them before, that's because they have just started a few years back. However, they were founded by former employees of the famous Dimensional Fund Advisors, including one guy who have served as co-CEO and co-CIO at Dimensional, as well as another guy who had served as COO. This means that the founders should know what they are doing, and true enough, in just 7 months, their funds had seen over $1 billion inflows, and just 5 years later, they have reached a $50 billion milestone. But what does this have to do with their ETFs? Everything. Unlike all the previous ETFs, these two ETFs are actively managed, which means you would only choose them if you trust their expertise. That's because, as we have seen from ARK ETF's performance, if you believe in the wrong fund manager, he or she can bring you all the way to Holland. So, how well are the Adventist funds doing? I would say pretty good. First, the US Small Cap Value ETF, AVUV, delivered a 16% 5-year annualized return, which puts it in second place, right behind RWJ, all while charging a slightly lower fee of 0.25%, which is actually pretty cheap considering that it is an active fund. Meanwhile, their International Small Cap Value ETF, AVDV, gave lower returns, but it is understandable as they are focusing on developed markets that are outside of the US. So a better way is to compare it to the MSCI World ex-USA Small Cap Index, which it is outperforming on all periods. The way these two ETFs work is by focusing on two key criteria: companies that are trading at low valuations, while at the same time getting those companies that have higher profitability ratios. So those were some of the most popular small cap ETFs that you can choose from. My personal favorite would have to be AVUV for their strong performance, but at the same time, I would also need to be cautious and monitor it from time to time, because it is still an active fund and there's always a risk of the fund manager making mistakes. If I want to avoid this risk, my next pick would be RWJ, as their tilt towards companies that have better earning power seems to be working. Otherwise, if I just want a simple passive ETF that is Ireland domiciled, I will go for IDP6, as the S&P index has a profitability criteria which can help to screen out some of the lousier companies. Lastly, how much should you allocate to the small cap index? I think most people would be perfectly fine by just investing in the S&P 500 index fund or an all-world ETF fund and just call it a day. But if you are looking to beat the market, JP Morgan suggests allocating only around 5 to 10% of your portfolio to small and mid-cap stocks. That way, you'll get to enjoy the potential upside without having to risk too much into small cap companies. Anyway, that's all for this video. Hopefully, you found it useful. Like, share and subscribe, as I'll be posting new videos every Monday, Wednesday and Friday.